Right now we're talking about why gold and silver have value. I think this is a really interesting question. This is a very common question on why gold is worth something. And we need to start with the two ways to classify money. We have metal money and government money. Metallism, chartalism, this being the Latin word for ticket. And the difference is where they get their value from. This is from metallism gets it from the free market, and chartalism gets it from the government. People in the free market have a demand for this metal. They seek it. It's going to solve their problem, and that creates the value. Governments can create the same value, the same demand, just by mandating that you pay your taxes in that currency. Sometimes this is called hard money. Sometimes this is called soft money. And there's a thousand-year-old debate about the answer. Which one of these is the real money? Which one is the best money? But the the point is that, and you can have both. Both are real money, and it boils down to if these items have a source of value, whatever that source of value is, as long as they have a source of value, then these items themselves are going to have value. And again, there's a lot of history in this debate. And that takes us now to the value problem when it comes to value. So if you have something that's valuable and producers can make more of it, and they make more of it, the more you have available, the less valuable that it's going to be. And this has to do with the supply and demand relationship. Producers can take the supply curve to the right, which decreases the value here. And so let's go through an example of increasing the supply. And the easy example is the game of Monopoly. So you have this game of Monopoly. Each player starts off with their set of money, and together all the houses and real estate can be bid up for $100 total. So now imagine that each player gets an extra set of money. What's going to happen? Well, they had the same amount of houses and real estate to bid on. They just have more money. So now they're going to keep bidding the prices up until the new equilibrium is reached. So the equilibrium is going to stay the same. It doesn't matter the amount of money that's available. So, and then now another way to look at it, if you're a producer and you have the ability to create these and keep them for yourself, this new equilibrium still stays the same, but now this guy over here just lost 50% of their money's value. And there are examples of this happening at large throughout history. The common one is the glass beads that were used as money in Africa. And in Africa, these glass beads, they fit the definition of money. They were rare. They were hard to get. And traders in the 16th century, traders from Europe showed up, and they discovered that these glass beads were used as money, and Europeans had the technology to make these glass beads, so they did. And then you can guess what happens next. They brought these glass beads, infused them into the African economy, completely eradicated the wealth of this civilization to the immense benefit of the Europeans. So we have learned throughout history. Some have learned the hard way that the value problem can cause pretty severe impacts. And both government money and gold, they solve this problem differently. And we're going to get to this one down the road. And right now we're going to talk gold solution, which is the stock to flow. And stock refers to the existing stockpile you have of something, and flow refers to how much you're going to add to that, usually on an annual basis. So because gold is indestructible and all the gold ever mined still exists, the stock of gold in our world today is 200,000 tons. And these numbers here are useful to know. They're related to each other. Every year, the world stock of gold increases between 1 to 3%, on average about 1.5%. That's a stock to flow ratio of 65. So, and currently this is what the world is making, or what the world producers are mining. And then a chart of the stock to flow ratio. So this is gold here at 65, silver's down here at 20, and you can see these, which is much higher than these other commodities. So these are just a few considerations, items you can look at that may impact this ratio. And we just walked through gold, which was a high stock to flow. Now we can look at what's a low stock to flow. Generally, it's called or known as an item that is easy to produce. And then, so using the low stock to flow, let's look at the value problem again, and we'll walk through what happens when you have a low stock to flow item that is easy to produce and it increases in value. So it increases in value, it's easy to produce, so the producers are going to make more of it and shift this supply curve out to the right. And now if there's a point of time where that price is going to remain sticky for a little bit, so the producers get to sell above the market price, where generally everyone else who's the consumer, they're going to be buying above the market price. They're going to be in a bubble buying above the price, and this bubble will crash, and most people are going to see their value plummet. The producers, they still win. And this is a way to view the value trap problem. Most people who are holding whatever this asset is, in gold, silver, a country's currency, it has the ability to drop in value if producers are making more of it because they can. And then in addition to that, if you already had it before this process started, then it's just like in a Monopoly game. Someone else shows up with double of what you already have, you just lost a percentage of your existing purchasing power. And gold, and so coming full circle now, gold has gold has value because it solves this problem very well. And really, it's been the only item throughout history that's proven that it can solve this problem. And let's get into this. The existing stockpile of gold is essentially not going away. It's virtually indestructible. And even if the price for gold is going to would go way up, there is no easy way to produce gold. The only way to produce gold is mining it. There's no shortcuts. The producers can't make more of it. Gold's just going to appreciate in value when the price goes up. And so this has proven to be the case for thousands of years. So gold has held its value consistently. The cost of a nice suit across 5,000 years has remained about 1 ounce of gold for the cost of that suit. So gold will hold its value. So now, on top of all those things we just covered, there's another concept that's working for gold, and it's called the network effect. So the network effect, so a solution starts off small, it's valuable, it's got a few users, but as the user base grows, the more users just increases the value of the solution, which just draws in more users, which adds even more value, and it's just a self-perpetuating cycle until you build this very strong network full of a lot of people. And this network also has an interesting way of pushing aside all the competition, and Craigslist is used as an example of this. So if you look at Craigslist, it's a service online that connects buyers and sellers. It is very basic. I mean, there's nothing novel or innovative about this service. It's just a simple web page. It's got some text on it. Then you compare that with Facebook Marketplace, and Marketplace is a far superior solution to Craigslist. And it's been competing with Craigslist for over 10 years now, but Craigslist still blows it out of the water. And that just speaks to the power of this existing network, the historic use of all those users in the network, the sticking power they have to it, of sticking within that solution that they know. And what I love about this is there's a really interesting counterpoint, or another way to look at this. So Blockbuster was a very large network of itself. And in just a short amount of time, a tiny amount of time, Netflix completely destroyed Blockbuster. So did Netflix, did they destroy and replace the Blockbuster network? Or did Netflix just take the network and took it on the next, self-perpetuating cycle of growth where Blockbuster could not. I think it's a really interesting piece to think about, and you can chew on that and probably learn a lot more about the network effect. So now back to gold and the network effect. This is the path that gold took, starting thousands and thousands of years ago. Gold then came to be the international standard for money, and then following that, gold put itself above human beings in terms of store of value. And here's another way same information on this slide as there was in the last slide. Another way to look at this. The value of gold has now transcended the need to trust in government, and the network that gold has traces back tens of thousands of years of usage. So to recap, gold solves a problem that is as old as humans, and gold has been the clear winner in terms of an item that can address the value trap. The high stock to flow ratio of gold has proven over time that it will hold its value. And then on top of all that, humans' relationship with gold, our growing network and trust with gold, it traces back tens of thousands of years. It's almost timeless. It started really with the dawn of humanity.